We might just get started rather than wait for the couple of people that said they're coming and for them to eventually come. Grab a seat if you're not having a seat, or stand if you want. That's not awkward at all.
I'll walk back across in a minute.
Thank you. Yeah, feel free to walk around. Feel free to interact and ask as many questions today. We're going to go through a few kind of top tips, or as what we like to call just the tips, just to cover off on some interesting things that you may or may not know when it comes to tax planning. But realistically, we're here for the next 45 hours, however long it needs to be. So if you want to get some free tax advice, just lay it on us. You're not paying us, so you can't hold us accountable to said advice. So it's all general in its nature. Big disclaimer. But my name's Andrew. I founded Illumin8 about 9 years ago, and this is Amanda, who is one of our senior team at Illumin8 as well. You might have seen us around the place. I think most of you know who we are. If you haven't, we hang out in unit number 31 with the fake grass and the lanterns, and every now and then we do some work, which is good. We work a lot within the e-commerce space, do a lot of e-commerce clients as well as a range of others like creatives and the like. But what we do find at this time of year is it's really important to have good conversations and understand actions you can or can't be doing so that you don't find out in October or November or December when you lodge your tax return how much money you actually have to pay the tax office, and it's a surprise. So the biggest things right now is often having the conversation and understanding what it looks like, even though you might not be able to do anything about it. Because at least you know what it is and you can plan for it, as opposed to having a surprise and it's being due in a week. Anyway, so we go through the tips. Amanda, before we get started, do you want to add anything else?
I think it's more just sort of what you said there about the two. My view on tax planning is there's two different sides of it. So some clients come to us and say, I want to do tax planning because I want to know I've got some money here to spend. Is there any point doing this pre-30 June? Is there any strategies we can do pre-30 June to get tax down, that sort of stuff? So there is that element. But honestly, we get a lot of clients where for tax purposes, there's not a whole lot we can do or benefit that we see. It's more just letting clients know how much, if there are any tax bills that they're going to be up for. So we give them maximum notice for cash flow purposes to plan for it. And sometimes it's a combination of both. So just because we talk about tax saving tips doesn't necessarily mean that they're for you. Sometimes tax planning is just about knowing and hindsight.
Yeah. Which is why we'll have a Q&A at the end. You can ask what the ones you want to understand.
Yeah.
So we'll start going through a little bit of it. Top tip number one is really starting with, is a tax deduction actually in your best interest? So the whole idea is that when, what we often get at this time of year is like, what can I buy? I think I need a new laptop, or should I get a new car, or should I buy this, or should I spend my money here and there? And it's always, what can I buy to save on tax? Which is really, really good, but if you spend $4 on something, you're only going to save $1 in tax. Amanda, what's a good example of something people are always trying to spend right now and their misconception of what that looks like?
Car, 100%. It's always the car. So this time of year, we get a lot of people that sort of say, all right, pre-30 June, immediate tax write-offs, and let's just claim this car and it's going to be great. But my first question to clients when they come to me and say, is it a good time to buy a car? First question is, do you need one? Do you actually need one? Because if you don't need one, why are you buying one? Because if you're just buying it to save on tax, well, guess what? As this says here, you're saving $1, but you're spending $4.
So that whole, and we'll talk about instant tax write-off in a minute, that whole thing that you'll hear from Harvey Norman or car yards or those kind of things where they say, hey, claim this and you can write it off in tax. Yes, you can write the cost of it off in tax, but you're only saving, give or take, 25% of that back. So if you're going to spend $1,000, you're not getting $1,000 back, you're getting about $250 back. And that means, are you happy to have $750 less in your bank account at that point in time? Do you need that new car? Maybe you do. And one of the things I like to talk about when you're looking at a tax deduction, does it help me earn more money? Does it make me more efficient and therefore manage my costs better? Does it help me to scale? Or does it make me feel so damn good that I'm going to spend the money on it anyway? And sometimes that's the case. You know what, I've really been eyeing off that new car, or I really saw this new version of a laptop that came out, or I want to go and spend a couple of grand on something here and there, and as a result we go and do that. But we really need to understand is, do I need it or not? Because maybe it'd be better to have cash in my bank to pay off my mortgage, or to go on a holiday, or to invest in digital currencies and the like. So continuing on, is a tax deduction in your best interest? To infinity and beyond. Amanda, talk to me about instant tax write-offs.
Yeah, so instant asset tax write-offs, a lot of you guys probably would have heard with all the COVID government incentive stuff that they released, the instant asset threshold went up to 150. It was previously $30,000. What that means is if you went out and bought a business use asset and you were classified as a small business entity, I'm not going to go too far into that, that's a whole different conversation. But if you did classify as an SBE and you were using accelerated depreciation, then you could buy an asset that was up to 30K after GST and write it off, claim all of it, 100% when you bought it.
And to clarify, that write-off is you don't get it all back, you get the portion of the tax component of it back.
Yeah, correct. It's a tax deduction. So then what happened was when COVID happened and the shit hit the fan, the government went, all right, we're going to up it to 150. And now they've just gone, you know what?
Stuff
No
it.
limit. To infinity and beyond.
So you could spend $1 billion on an asset tomorrow and write off the whole thing on tax, where ordinarily you'd have to wait for 5 or 6 or 10 or 20 or 30 years to claim the cost of that asset.
Yeah.
So buying that asset might be something that's really good. So let's assume it's a good idea and you should go and do it. What benefit are you actually getting out of it? It's accelerated depreciation. So you get the value now as opposed to having to wait 10 or 12 or 20 years to do that. So it does mean you're paying less tax now.
Yes.
It does mean a few other things in terms of timing, but it can create some complications as well, and we'll talk about that in a moment. Anything particular around that instant asset write-off from what you may not be able to go full 100% write-off on it to infinity?
Anything
See if you're picking up what I'm putting down here.
capital works.
Yeah, maybe motor vehicles.
Oh yeah, well when it comes to cars, motor vehicles, if it's a commercial vehicle, standard example of that is a van. Some utes, not all, please don't assume all utilities are commercial, they're not. But most, vans are utilities, that sort of thing, are commercial in nature. There's no limit to that, just go buy whatever you want. Please still keep a logbook though. But the other one is non-commercial, so you just want to go buy that Lexus and it's $80,000. And you go to your accountant and say, hey, I just bought that $80,000 Lexus and I'm a small business entity, so that's a huge tax deduction, right? I'm going to come along and go, no, it's not. Because there's a thing called a depreciation cost limit. So that's where the ATO put a limit in place every year, it changes, and they say, we're going to cap you and how much you can actually claim on depreciation, which with instant asset write-off is the cap of your tax deduction. I think for 2021 it's 59,000 odd something.
It's around. This is only for motor vehicles, and this is only for what's considered personal use vehicles. So the differentiation between a commercial vehicle and a personal is its primary use is for carrying passengers.
Yeah.
So how do you determine if it's not primary for carrying private passengers? Has 9 or more seats? Yes, it's for carrying passengers, but obviously that's in a commercial use or in a very fertile family. Or 1 tonne carrying capacity or more. So the ute that you have, can it carry in its tray, excluding passengers, by itself 1 tonne or more? Those 2 things typically mean it's a commercial vehicle.
Yep.
One really good example of a commercial vehicle that you might find, and I'm assuming that none of you here are going to look at it, but you might, is a Dodge Ram. A lot of people, you can spend 120, 130, 150 grand on these enormous utes.
Yeah,
they're actually classified as a truck because of their towing capacity, because of how big and what they can do. So that means you can write the full amount off.
Yeah.
But if you're going to go and get the 2-door Lexus sportsy thing or whatever, it's capped at that 59 grand. Not only is it capped at 59 grand for depreciation, but it's also capped at that for GST you can claim back as well.
And my biggest issue with what I like to call the luxury car limits and things like that is whilst you're capped on depreciation when you buy one and you're limited to the GST you can claim, you are not when you sell it. So if you go and buy a $150,000 Lexus and you want to claim 100% of it for business use, you can only claim the $59,000 in depreciation. You can only claim the $5,500 on GST. But when you sell it down the line for 110, because it's lost a little bit, but you've only owned it for a year, your accountant's going to come along and tell you that you need to pay $10,000 in GST, and that is an income add back.
Effectively, it's just the government making sure a whole bunch of rich people don't go buying Maseratis and Bentleys and whatnot and trying to write it off on tax. It's
so if you're thinking about doing it, please talk to your accountant first.
Yeah, and hey, nothing wrong with buying a $1 million vehicle if that's what you want to do. Just buy it in your personal name.
Yeah.
Yep. Second kind of level is a tax deduction in your best interest. We're talking about superannuation. It's about looking after yourself. So this time of year, often a lot of people go, oh, geez, I haven't put anything into super. If you run your own business and you don't pay yourself a wage, you are not legally required to put money into super, which is fine. You don't have to. But it might be a really good idea because 65-year-old Andrew will be like, hey, dude, thanks so much for chucking that money into super. Now I've got something to retire on. And if you're anything like my parents, they're like, yeah, but I've got my house and my business that I can retire on. And thankfully, the housing market's gone crazy where their house is actually worth something they potentially could. And their business, they've been working with great accountants so that it's actually worth something when they go to sell it. But looking 5 or 7 years ago with them, I was like, hey, the mum and dad, like, you are not in a position to retire.
Yeah.
Like, you're going to get to this point and you're going to have no funds. So maybe putting money into super is important. Now, we can't tell you whether you should or shouldn't. We're not financial advisors. Nice big disclaimer. You should always seek personal advice on that. Amanda, what's the difference between putting money into super when it is beneficial and not beneficial from a tax perspective, though?
From a tax perspective, well, when it's beneficial is, well, for starters, is there a need to do it? Are you in sort of the right position to do it? So we see a lot of small business owners where they're really heavily investing in their own businesses at the moment, and an accountant might come along and say, hey, you can get this huge tax deduction if you go chuck 25K into super. And that sounds great on paper for a tax deduction point of view, but then you actually have to part with $25,000 that you might actually want to invest in your small business. So that's when you need to look at where you're at. What are your cash flow requirements? Do you have a bit of extra cash to put into super? Prioritise it, please. Don't put it at the bottom of your list, because we see so many small business owners getting into their, late 40s, 50s, 60s even, and they turn around and go, well, I had a successful business, but I've got no money in super, and what's next when I, retire? So I think when it comes to being beneficial, it would be more so when you're in a position to do it. It provides you with a good tax deduction. It meets all the needs, ticks all the boxes, do it. When it's not a good idea to put money into super, again, big disclaimer here, can't provide, independent financial advice. But again, if the money is better spent elsewhere, you can put that money into super, but you've got to remember, you can't access it until you meet a condition of release. So you're kind of safeguarding that for the future you.
Condition of release typically means you're really old, really sick, or dead.
Yeah.
And all three of them typically are not great if we're young, fit and alive right now,
Yeah.
because it means a lot has changed. But typically we're talking 65 and plus is when you really get proper access to. You can get it a little bit beforehand. There is one other thing where it might not be in your best interest to put money into super. If you have not earned any income in your personal name, if you have no taxable income, or let's say you have 15 or 20 grand because your business made enough money and you paid yourself a small wage, or if you're a sole trader, small profit, and you got to put that money in a super and you want to claim it as a tax deduction, when that money lands in your super fund, the super fund pays 15% tax on it, on everything that goes in. If you've only earned $15,000 in your personal name, you pay 0% tax. So what you've done is you've taken 25 grand, let's call it 10 grand because it's easier with maths. You've taken 10 grand, you've put it into super, the government said, sweet, I'll take $1,500, you've got 8.5 grand left over. In your personal name, you had 10 grand, you don't have 10 grand, you don't get any tax deduction for it. You're actually worse off. So there's a point where, from a tax perspective, a contribution becomes more effective, and that's when you're earning more than, call it $20,000. Because at around that point, you're starting to pay 19% tax. And at least the tax saving on that contribution is greater than the deduction you've got when it hits the super fund. Does that make sense from super perspective? Anyone got any questions on putting money in super and how tax deductible might work? It's sometimes one that people creep up every now and then.
Whatever limits, like to...
Concessional, at the moment, the concessional contribution limit is 25. I think they're actually revisiting that and thinking of upping it.
The federal budget will be coming out soon, and we're expecting it to change.
I think they're going to revisit that one. But then there's actually the new rules that came in recently with the carry forward rule. So, for example, if in last financial year 2020 you didn't put any money into super, so you didn't put any in yourself, no other employees of yours put any money in for you, there's zero going in, you can actually carry that cap forward. So then what happens is the next financial year you can put 50 in if you didn't use it. There are other requirements that you have to meet to be able to do that. Your super balance has to be under $500,000, I believe it is. So that's your concessional cap. And when I say concessional, basically tax deductible point. Anything else that you put over that, if you're not carrying forward or meeting other things, that then goes into the non-concessional category, which basically means that you don't pay tax on it when it goes into the super fund, but you don't get deductions for it either.
So often non-concessional contributions might be lying around and you're like, I've got just a whack of cash sitting here.
Inheritance.
You know what? Like it would be better for it to be in superannuation because there's a 15% tax inside of super, or once I'm retired, it's a 0% tax inside of super. So why would I be paying, if I'm at the top tax rate, potentially 45, 47%, when I can be paying much, much less?
Yeah.
So people will often use that and start tipping in more and more cash into their super fund at the point where having cash around personally isn't as required as much.
We see a lot of that more with people that are sort of coming up to a condition of release when they're a bit later on in life, and they're wanting to get as much money into super as they can now before they retire, and using ways to do that.
We won't go into any more details on a couple of things I'm going to mention, but there are a few other little twerks. There's things called government co-contributions when you put money in and your income's at a certain level. And there's also spousal contributions as well, where you might have a partner who isn't earning money and you can contribute on their behalf. So there's a few other benefits you can get out there. If you want to understand them a little bit more, talk to us directly. And once again, financial advice for those things is sometimes required if you've got any deep questions. Another one on tax deduction, is it in your best interest? We're talking Marty McFly, we're talking Back to the Future, we're talking prepayments. We're talking what does it look like if I was going to pay something in like 12 months' time, but I decide to pay it now. And paying it now means the money's going to leave my bank account before the 30th of June for that expense. Amanda, some examples of what that could be?
An example of a prepayment that you're using in a year's time. I mean, I could prepay a lot of things. I could prepay my rent. And again, that's a discussion that you have to have with your landlord. But that's something that a lot of people do consider around tax time, is prepaying rent. But again, be cautioned with that because you're also making commitments for longer periods in time as well.
So really it's anything that you might be incurring over 12 months. It could be insurance, it could be rent, it could be accountant fees, anything that you know happens. And our advice when it sits around prepayments is, if this is something you know you're going to incur, you're definitely going to pay it, it's going to happen, I've got a wad of cash lying around, I've got a tax bill that I'm staring at, well, why don't I pay that now? Now, important to note here, you're just deferring the tax timing. Because what happens is we've brought that deduction we've claimed in this year. So we go next year, we go, crap, I don't have that tax deduction because I paid it last year. So what we're doing is we're kicking the can down the road and making it next year's tax problem, which isn't a bad thing if you want to have some more flexibility in terms of your tax in this year.
And this is also something I like to bring up with clients as far as the immediate asset write-offs go as well, with claiming those large depreciation sums up front as tax deductions. It's great now, but what that means is in the future, that depreciation is gone. So you're not going to be claiming it next year. Instead of spreading it over 5 years like you would normally, it happens now, it's great now, but it just means that, again, the next year we don't have it anymore.
One of the other things you might find as well with some prepayments, depending on who you're talking to, you might be able to get a discount for paying it 12 months in advance or even more. One really crazy example that I heard of that I didn't even know exists is if you run a company, you'd be used to paying ASIC every year, a registration fee of around a couple $100. They let you prepay 10 years in advance. And you get something like a 25% discount for doing so. So it's actually a pretty serious discount. But you're sitting here saying, my business, my company will be alive in 10 years' time.
I think I worked it out. It was about $900 for a standard company that you saved.
You're saving $900 over 10, which is, it's nothing to shrug your nose at.
No,
but you're spending
it's
a few
commitment.
grand to save $900.
Yeah.
So something, but other things you can have. You could talk to people in your world that you know you're going to pay money. You're like, hey, what if I pay 12 months in advance? Can I get a discount on that? Would you? Because you know when you pay monthly, they'll charge you a little bit more because it's more administration, more transaction fees. Something to be aware of. Top tip number 2. Get your shit in order, please. And this is something that we see so often when we have clients who come to us and we do tax planning, or maybe they go, oh no, I don't need tax planning, don't worry about it. And then they come to do their tax return and they're like, all right, so I'm buying a house this year, I need my taxable income to be like $1 billion so the bank will give me money. And literally, it's like we had one recently. It's like, oh, so I've bought a house. My income needs to be this. So we're like, dude, it can't be that. You literally didn't make that money. It didn't happen. So, but he's like, oh no, but I need it. So surely we can't just pull numbers out of thin air and make it happen. Now, there are some things we can do to be flexible and claim certain things and operate within the space of the law, but you've got this conflicting idea between I want to borrow money and I don't want to pay tax.
Correct.
So if you want to borrow money, your income needs to be as high as possible. So the bank goes, you're awesome, here's a bunch of money, have fun with that. But you're going to pay tax on it because you've got all this profit. You don't want to pay tax, we want to reduce and claim everything we possibly can. We use a whole bunch of things, like we might put money into super or buy an asset or do some prepayments. But if you walk into a bank, they'll laugh at you and tell you get it stuffed. Even if you say, oh no, but I prepaid these things. They're like, I don't know if that's going to happen next year. Based on the numbers I'm seeing, it's not possible. And banks are really bloody tight on this now. And if you've had to go for finance any time recently, they might have asked you to say, can you get your accountant to sign this document? We're not legally allowed to sign those documents. Our insurance does not cover it. And those documents effectively say that your business is healthy and fit and capable of managing a debt like this. Technically, we're not. Now, some of them, depending on the wording, we do. Others, we just say, look, we're really sorry, but we can't. It's just banks trying to push all of the problems onto the accountant so they can cover their ass. But understanding this is so fundamentally important because if you're going to go borrow and we're sitting down at tax planning time, you make those decisions to decide things so that when you get to do it, you know you have the ability to borrow those funds. Because there's nothing worse than finding the dream home, like this client of ours has twice now, and find out that you can't borrow. Yeah, he did the second one. He thought, oh, I didn't get the funding for the first one, so I'll buy another house, but I'll spend 200 grand more on it.
But it's all just the way you strategize it, right? So, for example, if you're not looking at getting finance and you are looking down the barrel of huge profits, huge tax, and then you go, all right, let's put these strategies in place, let's do some stuff. And we can do that. But if you turn around and say, all right, I want to go for finance, then we might say, okay, well, instead of doing all the prepayments, let's not. Let's wear a bit of the tax now, make your financial position look healthier for the bank, and then we'll just claim those deductions the next year. So it's not like you miss out. You're not missing out. It's just timing.
I'd also recommend if you're in that position, I would be working with a mortgage broker. So not going direct to a bank unless you really feel like that. Mortgage brokers typically won't charge you anything. There might be a slight cost differentiation in the interest you get, but really we're finding they're on par with going direct to a bank. That broker and your accountant should talk. And be like, all right, cool, so we're going to spend $1 million this year. Okay, what do we need? I need to see 200 grand of profit. Or, of the partners on a wage earning this much, I need the business to at least get to this level. Cool, we've got 2 months to plan that out now, and now we're prepared. So 100%, talk to a broker, get them to talk to your accountant. If you don't have a broker, we can connect you with a couple that are great.
Brokers are, they're always super important, but they're, especially now with all the COVID stuff happening, they're even more important because they're across all the banks and their lending requirements, and the bank's lending requirements are changing rapidly. And they're all different with how they're treating a lot of, for example, all the COVID incentive income, how it's disclosed. Some of the banks don't like it, they'll let it back. Other ones are letting it through. Depends who you're going through. Brokers will know that. Your alternative is lining up, going to 20 different banks yourself.
It's been a really weird time with finance because of if you've received JobKeeper or cash flow boost or state grants, technically that's supplementing the income that you would have already had there. Now you might not. A lot of e-commerces we saw, I didn't see one e-commerce who got it from our perspective, but there are some that did. But if you have any kind of government benefit, banks will often say, no, we're not going to allow that. Be like, what, hold on a second. That just shows you the reality of what would have happened if there wasn't a global bloody pandemic. Unfortunately, banks are a bit too robotic to understand that. So we talked about that. If you don't want to pay tax, you minimise your taxable income. The other thing that's really important around here is consistency. In business, the ones that I've seen that succeed are consistent and structured in their approach. They don't have these massive highs where, okay, cool, I need to buy something, I don't want to claim anything, and then massive lows where I don't want to pay any tax. They have consistency, so saving cash for tax is something they become really comfortable and they get used to. All of those things are really, really important. So if we're having this constant up and down, we're never getting in a pattern where we understand our numbers, we know how well our business actually performs, and we can be preparing ourselves going forward.
When we talk about consistency, I'm not talking about businesses that are seasonal. You can't help that if your business is seasonal. It's more just how you manage it. Consistent management approaches, especially with cash flow.
Yep. Number 3, the big fat C, Ovid. Amanda, you are all over this.
Yeah. Okay. What's taxable, what's not? Because there just seems to be a lot of differing opinions about this out there, we've realised, as we're preparing a lot of 2020 tax returns and coming into 2021. JobKeeper, it's taxable. Sorry, there's nothing I can do about it. Pay tax on it. It was free money, guys. Come on, pay some tax. Cash flow boost. Now, pay-as-you-go withholding cash flow boost. That was the one where if you employ people and you paid pay-as-you-go withholding, the government gave you some free money back on that. That is not taxable. That's tax-free. Great. Government grants. Now, that's a tricky one. There's a bunch of different grants out there. The main ones that we see are the 10K ones, which had 3 rounds. So the first round, 10K, that is taxable. That was done in 2020. The second round, which is in the 2021 financial year, that was the one where they initially gave you 5 and then they came back and said, oh, we'll make it 10 and gave you another 5. That is also taxable. And the third and final one, which is the last one of 10,000, I don't know why, but they just came out and went, you know what, we'll give you a break. That one's not taxable. So when you go to give all of your stuff to your accountant for year end and you have a grant in there, maybe just make a little note on it to tell them which round it was or give them some documentation because they'll need to know because they're treated differently.
It's quite funny when the government gives you 10 grand and they go, I know I'm only really giving you 7.5 because you're going to give me 2.5 back when tax time comes.
Thank you.
So they're like, sweet, look how generous we are.
Yeah.
Suck it.
Yeah.
Did anyone here not get the first round of the state government grant? Do they apply and get knocked back? All right. That's cool. If you know someone that applied and got knocked back and did not get the first round, this morning or last night, the Ombudsman has said, state government, you're a bag of dicks, that's not okay. They're actually going to allow them to be paid. So there is a bunch of people who applied who were told that they were not allowed to get it and will now receive 10 grand. So if you happen to be chatting to a mate and you remember them complaining about not getting anything because they were a sole trader or they were a business with this or that, just be like, hey, did you get an email? Did you? If they actually applied for it and got knocked back, it's quite likely they'll be able to get. Apparently, there's about 1,200 businesses in Victoria that is going to get access to that, which is really good, and that's something that I guess I felt the pain on behalf of others. Is like you're sitting there and you're like, I'm sorry, like you apparently don't fall into a basket that needs it, even though you're the sole income owner of your family, you run a sole trader business, and you have no money there. But all these other big businesses get it.
But this was also the scramble, right? This was the COVID scramble. It was the first round of grants. They were just trying to get money out to people as quickly as they could. They were making things up on the fly, and that's what came out.
Yeah, not to spend too much time on the big fat C because we don't like it anymore. But if you thought you were eligible for JobKeeper or you received it for 1 month and then you were told you weren't eligible and you thought that sounds a bit weird, but you trusted it anyway, it's quite likely you actually are eligible. We've worked with about 3 or 4 clients now to back claim like tens of thousands of dollars of JobKeeper. So if that was you in that position, feel free to tap on the older version of me that's sitting up the back, Jason. We're not related. He just looks like me from the future. If we're talking Marty McFly, when we first met, I thought he was coming to warn me of something, but he didn't. Top tip number 4. This is what we call the classic switcheroo. Or what I have called the classic switcheroo. It's a bit like a prepayment, but from a cash perspective, there are 2 ways, tax perspective, there's 2 ways to track your tax.
Yeah, cash or accruals.
What's cash, what's accruals?
What is cash? So cash and accruals, the difference between the two. For example, one of the things that we can kind of talk about with tax planning strategies come 30 June is saying, all right, Andrew, you're my accountant and I pay you X dollars per year. How about you give me next year's fees in advance? Invoice me. Just invoice me the fees in advance because I want that tax deduction.
Great.
So you generate an invoice at 30 June.
Yep.
I don't pay it though. I'm not going to pay it till later, but I just want the invoice to come in.
Okay.
If I'm on an accruals basis, that's a tax deduction. I can claim that. Even though I haven't paid it, that's fine. I can still claim it because it's in my system. The bill has 30 June on it. Same goes with your income. When you're invoicing, if it has within that financial year on it, then you're paying tax on that income because it's accruals. Cash, if Andrew gives me that invoice at 30 June and I don't pay it to the next financial year, too bad, no tax deduction because I'm on a cash basis. I only claim deductions when they're paid and I only pay tax on my income when it is received. So which way you go, often that ends up being your accountant's call because we will look at the balance sheet and we will determine where you're sort of at. One of the big flags for me is businesses that come to me in their first or second year of trading and their balance sheet, they might have $100,000 worth of debtors sitting there unpaid.
Debtors being people who owes you money.
Yeah, so 100K sitting there, people that owe them money. And they're looking at a huge tax bill. They've got no creditors, i.e. bills sitting there because they pay everything on time. They're really good at that. But they've got this 100K and they're going to pay tax on that. So I might go, right, let's swap you to a cash basis. You've already paid all your bills, so they're all tax deductions anyway. And that means we don't have to pay the tax on that 100 that's still sitting there.
This is really important because most of the time, tax returns are done on an accruals basis.
Yes.
For businesses, most of the time, because if you're running your accounting system like a Xero or something and you're doing it really, really well, you're putting your bills in before you have to pay them. You're raising your invoices before you've received the cash. And if you're using your website or whatever other kind of things, it's feeding all that data in. So when you get to the end of the year, it'll say you made 100 grand, but it'll say someone owes you a certain amount and you owe people a certain amount. Those things that you owe might actually mean you pay more or less tax if you go cash or accruals. GST, different. GST typically is cash for pretty much every business that I'll ever meet. Until you start turning over big dollars, that's when you move to accruals and you're kind of forced to. But typically it's cash. So cash is really, really, really good until the next year. And if you go cash in 1 year where you had 100 grand where people owed you, but then the next year no one owed you money and you owed 100 grand in creditors, that cash all of a sudden backfires on you because you got to claim the deductions in the first year and now you've had to deal with the other way and it's all of a sudden done a $200,000 switch. So this is important in terms of when you've had a really weird year, but you'll be more consistent going forward. Or if really your business operates on more of a cash basis anyway, it makes sense to do it that.
Yeah.
Any questions on cash or accruals? Good, I like it. We must be answering things really well or confusing the shit out of you. So yes, carrying a lot of creditors, as we kind of said. If you're carrying a lot of creditors, i.e. you owe money to people, you're better off being on an accruals basis because you have not yet paid your bills, but you're going to get the deduction for it because it's sitting in there. What that means, and Amanda kind of hinted at, I think we might have it here. Yeah, what we call push income and pull expenses. So when you're on an accruals basis, what you want to do is only invoice for what you have to invoice. If you're sitting there and it's like, oh, we've kind of half done the job, but I'll send a $20,000 bill out for it because it'll look great on my profit, you're paying tax on that. Or if you're sitting there and you're going, oh, I know that I've incurred all these costs, but I haven't received the invoice, get on the phone to all your suppliers, can you make sure you send the invoice? And I need that dated before the 30th of June. Because then it hits your system and you can claim all your costs and you're not having to pay tax on income that you actually haven't even generated. It's really, really common in service-based businesses where they might invoice things in advance before they've actually done the work. Because you have that kind of line. It's what we call push income into the next year, pull expenses into the current year. Yes, but we're aware, like we said, if it's raised pre-30 June, you're paying tax on it. And the last one, obviously, we talked about getting all your bills in your system there as well. Top tip number 5, and this is kind of a last tip before we go to any Q&A kind of thing. Think about the future and think about how you're structured. If you're a sole trader, a partnership, hopefully you're not because I hate them, a trust or a company, all of those entities pay tax differently. At the end of the day, the tax you pay is what comes down to you as the individual, as the business owner. So even though you might have a company and a company pays a tax rate of 26% capped, eventually you'll pull money out of that company based on the profits you make, and then you'll pay tax on the money you pull out, and you'll get a credit for whatever the company's done. But it's really important to think about the structure you have because timing is really important. Let's say you made $500,000 this year. Well done. But you're keeping the money in your business because you've got a bunch of stuff coming up. You've got a new marketing program, you've got new products that you're going to go for, you're going to hire a bunch of people. You want to have that buffer sitting there.
You want to reinvest it.
If that money's in your personal name, you're paying a couple $100,000 tax.
Yeah.
If that money is in your company, you're paying much less. And I've got a little diagram for it right here. If we make $150,000 as an individual, you're going to pay about $57,000 tax, which means you'll have cash left over of $92,000, assuming you had no debtors and creditors. As a company, you'll pay $39,000 and you'll have $111,000. As a trust, and I've got a little flag here, as trusts, and I'll explain trusts a bit more if you need it. We're assuming we have a couple of kids that we could distribute who are under 18, a couple of adults, maybe partners, husband and wife potentially, and maybe another family member, could be a parent who's retired. Potentially, you can get your tax down to $25,000. Potentially, you can get it down to zero with a trust, which means you have significantly more cash left over. Because it's all about cash at the end of the day. I don't care about tax deductions. I care about cash that's left in your bank account.
When we talk about distributing with a trust, I'll sum it up super quick, high level. Basically, that $150,000 of profit, if you operate out of a trust, that cannot sit there. The money must go out. And where it goes is to beneficiaries, right? And more often than not, those are people, individuals. So that might be, for example, your mum and dad company. It might be mum, dad, and 2 kids. And depending on the kid's age, depends on how much money they can get. But what we talk about distributions is that's where we go, right, we've got $150,000 sitting here. We've got 4 people down here. How do we give the money to create the best tax result? That's basically called income splitting. And that's what we look at. So that's why you've got such a big difference, because those taxable incomes, that 150 is being split so many ways that they're on lower tax rates. So that's why they get that big saving.
It's incredibly valuable when you have a broader family. Now, typically, when we advise people on running businesses, we say that they should run their business out of a company, but their company should be owned by a trust. And the reason being, tax rates capped at 26% when we make profit, so any retained money we're keeping, we're not having to pay tax at higher rates on. But when I pull it out, it goes into a trust, which I can then choose to distribute to individuals. And if I've got different people in my family, maybe one of them owns an investment property, maybe one of them is earning a significant amount of money, maybe one of them put some money in Bitcoin and made $1 million profit in 1 year and sold it. Every year it might look different. And with a trust, it's often called a discretionary trust, which means at your discretion every year, you can choose to give more or less money to the people that are allowed to receive that. So a company, you're protected from risk, you've got fixed tax, you know it, you can predict it, it's all good. When you pull out the cash and are going to be taxed to individuals, you know that you have ultimate flexibility on it. And as I kind of hinted at before, this 39 grand that's paid by the company, when it eventually ends up in the individual's name, which it might go via trust to be in an individual, super complex, that is a credit. So if, use an example, if the company was only owned by an individual, it made 150 grand profit, it paid 39 grand tax, and the next year you pulled out the 150 grand and it ended up in the individual's name. The individual would then have 150 grand of taxable income. It would pay 57 grand, but it'd get a credit for what was already paid. So you're only paying the gap tax. So you can see it's really important is if all of a sudden I have 4 or 5 or 6 individuals that I could distribute to, this amount is not 150, it might be 20 grand. If it's 20 grand, my tax is 0. And if it's 0 and I've got 39 grand of credits attached to it, I get a refund of those 39 grand that the company's already paid. So structure is complex.
Yes.
And I might have confused the hell out of you
Very
with all of this. But it's actually something on a long-term basis, you could potentially be saving 32 grand a year on 150 grand profit, which is pretty crazy. Any questions on structure?
Buy your blackboard and just.
Yeah.
I have been asking for more whiteboards around here. That's why in our space we have one whole wall that's a whiteboard. I can come and draw it up there for you if you need. I want to make sure I didn't miss anything on these. No. Lumpy.
Good question. You said you can distribute to people, children under 18.
Yep.
I got my accountant said you can't.
You can, you're extremely limited. There is a cap of $416. That's it. That's all they can get.
So it's protecting, the whole idea is that they're calling it, it's like the Collins Street farmers. They're making sure that these people making $1 million on Collins Street don't kick out all the profits to their kids and pay less. So your $416 you can get it, which is about a $120 benefit potentially at 30%. Then you pay like 66% tax for a bit, and then you go back to normal. So it kind of loses its allure. But the beneficiaries of a trust, if I'm listed as a beneficiary, automatically my wife, Ivana, is listed. Our 2 kids are listed. Either of our brothers and sisters and nieces and nephews are listed. Both of our parents and our grandparents are listed. And our aunties and uncles are also listed.
By default.
So you can see all of a sudden, all I need to do is have one person that's a beneficiary of a trust, and I have an entire realm of people I can do to. Now, that's all well and good that I have them. If you don't get along with your auntie and uncle, you don't want to distribute the money. You're not giving them actual cash. We're kind of doing it as a paper transaction. They sign off to say, I've received the money. Thank you, tax man. So it is still legal for people who don't run businesses or don't have trusts. They might not like it because it's like, oh, you get this benefit. But we're also like, yeah, but we're running businesses and now you have things to eat and enjoy because of what we do. So it's part and part of that. The other thing you do have with a trust, and I don't know if anyone in the room is like this, most trusts allow you to distribute to what would be called tax concessional entities, often a church. So if you go to a church, whether it's Muslim, Hindu, Christian, Catholic, whatever it is, most of the time, giving money to those organisations are not tax deductible, and rightfully so, they shouldn't be. But if you use a trust, you can distribute your profit out. So if you had $150,000 of profit, but you actually gave 50 grand to that religious institution, you can distribute that out, which means they pay tax on it at 0%. And therefore you're only paying tax on what's left over. So if you're in that position and that's something you do, you're interested in, you can talk to us a bit more about that as well. Any other questions on structure?
Could you go from a trust, so a company to trust to another company and another trust?
As in, I have a company, I pay a dividend to a trust, and then I want to that's often what's referred to as a bucket company. Yeah. So it's a way of deferring tax because like, shit, I got this huge tax bill, all right, I'll put it into a company. It is complex, it costs you money to do so, and the value is really connected to the fact that you might have had a tax situation that was beyond your ability to impact.
The highs and the lows is
the highs and the lows.
Yeah,
you can definitely do that, yes. You can restructure. So if you're sitting here and you're saying, oh, I'm a sole trader and I'm making 150 grand, shit, I'm leaving like 30 grand on the table, that's bullcrap. You can become a company or a trust. It's definitely doable. There's a catch though. Restructuring is effectively you're selling your business from yourself to a company. The tax man says that's related parties because it's your company. Therefore, you must sell it at market value, whatever someone in the public would pay for it, and assume that's the money you receive for it, even though you didn't receive it. And then you have to pay tax on that transaction. Sounds really crap. The great thing about it though, is if you're a small business, there's small business concessions. So we can pretty much write that gain down to zero and you pay no tax on it. It's complex, bit of advice. Normally it's a couple of grand to do it properly. But there's actually a really great opportunity if you're potentially looking to build your business to sell it, and you're currently structured in a way that you don't want to be, to restructure, increase your cost base, i.e. what it costs you to start the business, because typically it's nothing because you just started and away you went. And then when you eventually sell, if you sell for $1 million and we were able to restructure and say it was worth $500,000 at the time, you're only making $500,000 profit instead of a full million. Once again, crazy weird stuff, but if you're thinking of restructuring or if you have a plan to grow your business and sell it, timing of restructure can be incredibly valuable. I just literally doing one at the moment, and we're going to save a client in about 5 years' time, 900 grand.
A lot of the time tax planning is when we see a lot of this stuff, because we're clients that don't do regular advisory meetings with their accountants. They just like the old idea of coming in, getting their tax done. Maybe they do a tax planning meeting once a year. We find a lot of the time that's the only time we've actually had eyes on the year, how it's gone. So the accountant will look at it for tax planning purposes, and we might actually look at what they're doing, profit levels, and be like, oh crap, we think these guys need to restructure now. So this time of year is super important to be reviewing those kinds of things.
The other thing with restructuring, setting up an entity costs money,
Yes.
and then you have to get new bank accounts, new ABNs, you have to advise everything has to change. So administratively, it can be a bit of a pain in the butt. Like I said, got one that we're going to save them about almost $1 million over the next 5 years, but they're going to have to spend the next 2 months in a little bit of pain for it. But I think it's worth it.
Cost versus benefit.
I reckon it's worth it. I don't know, $1 million, couple of months of administrative duties, sounds all right. Have we got any questions? Now this can go to anything. If I haven't covered anything today that you go, I have a question because my mate at the pub said you can, or if something we said today you wanted to tack on a little bit more, or if you don't, feel free to nick off, that's okay, I won't be offended. We are Unit 31, you can knock on our door and chew our ear off within reason whenever you like.
I was going to ask about the accrual versus cash basis. Is there any where you can't choose that, like they make you go one or the other, or it doesn't matter what they what?
If you've swapped, so if you've gone, so when you start your business, it's the first year, take your pick. You can pick whichever. But if you change methods, you must stick with that method for a couple of years, because you can't just chop and choose every single year and go cash accrual, cash accrual, cash accrual. Just whichever suits you, you have to stick with it.
And scale as well. I don't know the exact number,
Yes.
but I believe it.
It's you got to be
I think it's a good, a serious in the millions kind of number.
Yeah.
And
Businesses can't choose.
yes, small businesses can't choose.
They have to be accruals.
Non-small businesses, you mean?
Small businesses can't choose.
Sorry, this is Mick, who leads our accounting team.
If you're not a small business, and there's many different levels of small businesses, there's a 2 million cap, there's a 2 million turnover, 10 million, 50 million. Whichever threshold they're talking about in this sense, you can't choose. So
If you're above it.
If you're above. So if you turn over $10 million, and no offence to the room, but I don't think that's going to impact any of us, you can't choose, you have to be accruals. So you have to declare your invoices when they're received, declare your invoices when you send them out as income, and declare your bill when you put them in your system. But for most small businesses, we can choose. But as Amanda said, you can't just chop and change.
No.
If you're typically a business in the services industry that carry your debtors for a long period of time, so real estate agents, stuff like
Yeah,
that,
that's a big one.
people that issue their invoices and they're typically not getting paid for 6 or 9 months, definitely look to switch to cash, because you don't want to be paying tax on that income that you're not likely to receive for 6
For cash flow, it's just too hard. It's too hard to manage.
Yeah. It's just something that we look at tax planning time, but yeah, for most of our services heavy businesses, we do review it pretty frequently, and if they do carry a lot of debtors, we just typically switch over to cash.
Amanda did mention often it's at this time of year where like accountants will figure this stuff out. Really probably good reminder that you should maybe tap in the shoulder of your accountant and say, should we be meeting more frequently about this stuff? Because if I'm having all of this stuff dumped on me in April when I'm trying to deal with year end coming and all this other stuff, like it'd be great if I had a bit more warning around it. So we typically advise 2 meetings a year is really good. Do one around Christmas, January if you're seasonal Christmas products, and obviously structure the timing better, or even more frequently if you feel like you're going through growth and you have a lot of needs that you need to get through. Your accountant can be an incredibly good source of feeling the heartbeat of your business, but picking up some things the more they're looking at it, because as much as we like to be proactive, we have 400 clients that we're looking after, and we can't be thinking about every single one of them every single moment. Any other questions on tax? Yeah?
If you use company funds to buy crypto assets,
Mm.
assets gambling, what are the tax implications once they're realised?
Firstly, I hope that you're not using a trading company to buy crypto assets. You can still use the cash, but hopefully you're buying it in the name of something that's not the trading company, because you don't never want to blend investment and business trading, because if something goes bad in either of them, you could be causing some issues
You're
against it.
exposing
So you want to separate the risk.
Yeah.
Shane, who's up the back, is our resident crypto expert. We're actually planning on running a crypto session later this year, because we've got a number of clients that have made a number of dollars out of it lately, and it's just continued to become a hot topic. Anything to add there, mate?
So crypto is treated a lot like shares in that respect. So they're treated like an investment up until the point where you'd be considered in the business of trading that asset. And so taking this back to shares, stockbrokers, share brokers, everybody knows them, like, you know, they'll buy and sell shares every single day, and they'll try and make little bits of money off those margins. They are in the business of trading shares, and therefore normal investment rules don't apply. But for most of us that are like dabbling in crypto, because my mate said to get into Bitcoin or whatever, those rules don't apply. The rules that apply are typical capital gains rules. And that generally means that if you've held the asset for longer than 12 months, that means that you're going to pay tax at the time that you sell the asset, and therefore if you've made a profit, you will pay tax on 50% of the profit, assuming you've held longer than 12 months. If you held it less than 12 months, you'll pay tax on the entire profit, assuming you've made a profit, which with crypto is a...
Who knows? Mate, I made some cash. It's all good.
The big disclaimer on that one though, companies don't get it. So,
I think the important thing is if you've made a loss and it is treated as capital, which 99 times out of 100 it will, you can't use that loss to offset other trading income. It's a capital loss, so it just sits there and you can only use it if you
correct.
Yeah.
So a lot of people are getting caught with that. They lose a stack of money on crypto and they don't get a tax deduction for it. It's just lost money.
So best example of that is if you're an employee, make 50K a year, and you got $10,000 of losses on crypto. Your taxable income is still 50, it's not 40. But if in the next year you make $20,000 on crypto, you're only paying tax on 10 because you're carrying forward that loss from the last year to claim again.
The other thing to be aware of when you're playing with crypto is moving funds around between different wallets or different cryptocurrencies can be considered a sale of that asset. So all us accountants kind of go,
we cringe a bit at
we
crypto.
have a few clients that go hardcore.
Yeah.
So if you're moving it from a wallet to a wallet to a wallet to a wallet, that could be considered a sale every time you move it from one wallet to another. It's and I don't want to spend any more time because even like I have to sit back and review through it all. Shane knows a fair bit of it. It's still very, very complex. We will look to run an actual event on it because so many people either know what they're doing or chucked a couple of bucks in and all of a sudden it's worth 20 grand. They're like, shit, this is cool. And seeing what's happening with it.
But Andrew, if you're buying crypto, Andrew, not you, Andrew.
Oh, sorry, Andrew.
If you're buying crypto on a trading company, come have a chat.
Don't do it.
Yeah, I hear it, yeah.
Come have a chat.
That's the separation of risk and assets. Typically, if you're in a spousal partnership and like it's a solid rock foundation, everything's all good, and you run a business, the assets you probably want your spouse to own or vice versa. If you don't have that situation and the assets you're investing are quite substantial, a big crypto investment, a property, shares in another business that you've put some cash into, you might want to set up a trust to hold that for you, because if you come under attack because your business doesn't go well or you accidentally do something you shouldn't have and you're sued, your assets will be exposed to those creditors, so you want to protect them a bit. And scale is where it comes down to. I was chatting with someone, they're like, I'm going to put 10 grand into just some blue chip shares and let it roll for a bit. Should I set up a trust? I'm like, nah, mate, don't worry about it. It's not worth it.
Yeah.
But if you're talking about putting 150 grand in, we might start thinking about it because the value of that asset and the potential for it to grow and the income that it will generate might be better to be protected.
Yeah, it's worth noting a couple more things in the crypto side of things. One, if you've spoken to someone about advice on crypto from a tax point of view, even a year ago, it's somewhat times worth reevaluating that advice. ACO is putting out bucket loads of advice that's taken through the courts constantly at the moment, which is setting new precedent on how this is treated from a tax point of view. So literally like what's true today can be completely different to what was true a year ago from a tax point of view. The second thing being as well is particularly with trusts and companies, being able to actually say that this trust or company owns this crypto is extremely difficult right now because there's not really any way of assigning the ownership of this particular crypto to that legal entity. And there's a lot of case law coming out at the moment saying how you actually assign the ownership of this asset to this legal entity. So if you are doing it, don't just do it. If it's important, it needs to be in that particular legal entity. Speak to someone who knows something about this, because if you sell it 3 years down the line,
You could get
it's
caught.
actually in your personal name,
Yeah.
you're up shit creek.
Yeah. I'm paying a lot of tax.
What's you also hear, and I had a client talking to me the other day. Oh no, I'm investing and I transfer it into this wallet because it's an unregulated wallet, which means the ATO doesn't know about it, which means I can make $1 million and transfer it out, and I won't have to pay tax on it. I'm like, yeah, sure. So how are you going to explain to the tax office that $1 million just hit your bank account, or you went and bought a boat, or what happens if next year they do now know about it and they start literally had an email as I was looking here going, oh. Client goes, I think I should probably start providing information on my cryptocurrency investments this year. I've been doing it for the last few years. I just haven't really provided. But I've been making losses, so it's probably not that big of a deal. And we're like, oh, God.
Historically, the ATO put crypto in the too hard basket. They
did not.
did.
For a
They
good
just
10
went, you know
years, I
what,
had
we don't
no
know
idea.
how to manage this, so we're just going to let people kind of just do what they want, and everyone went cowboy on it. But even now, we've started seeing on pre-fill reports that we get from the ATO in regarding individuals, it says on there, we believe that your client has bought or sold cryptocurrency. They're aware. They know that you're doing it. They know.
They've got some arrangements with big sort of crypto data brokers that basically means that any crypto exchange or broker that's worth their bacon as such, they will have declared their information with some kind of information broker. That makes its way back to the ATO. So there's literally, if you've had to provide any ID at any point in time, the ATO will know about it either this year or sometime the next couple of years.
Yep.
I think that's enough crypto for the day.
Yeah.
Yeah, sorry.
I'm
Yeah.
sweating, man. I'm
This come up recently, or yeah.
Yeah, it's a thing. And it'll only continue to be
It's
more
a
of
lot
a
of people
thing.
are doing it, yeah.
And also, as we said before, if you're thinking of doing crypto, talk to a financial advisor, although you might struggle to find one that truly understands it. They're getting better at it now. Any other tax questions? Anything you're looking to do that you're like, hey, is this a good idea? No, don't buy a horse.
Oh, I mean, you can.
You can if you
Why
want.
not? Why wouldn't I? I'd like to have a horse.
Yeah, I'm
That'd be
sure
nice.
you'd love. My daughter would love to have a horse too. She ain't getting one, I can tell you that.
It's not tax deductible.
We live vicariously through our friends. And every time we go there, I'm like, we should never visit these people again. Because every time, oh, when am I getting a pony? Cool. Thank you, guys.
Thank you very much.
As always, grab us if you've got anything particular you want to talk about. We're around here, happy to help.
Thanks, guys.